In this lesson, we're going to talk about the New York Mercantile Exchange. It is the predominant energy commodities exchange in the world. The picture on the left shows the Nymex building on the Hudson River in New York. It's the one with the sun kind of gleaming off of it. And to the right, this was not staged. This is an actual action picture of the traders in the pits who are yelling out orders to one another. The exchange itself, you can picture a city like New York back in the early 1800s. There were a lot of scattered markets around the city for goods. You had no consolidated central market area, but you also had some farmers mostly who came to town and wanted to pre-sell a crop that they were going to have, let's say for instance in the fall. So a group of entrepreneurs in New York City put together what they called initially the Butter and Cheese Exchange in 1872. In 1880 they would add eggs to that, so it became the Butter, Cheese and Egg Exchange. But then in 1882 it was changed to the New York Mercantile Exchange, which is the name it still holds today. Later products besides butter, cheese and egg, they had onions, apples, potatoes, plywood and platinum. Now platinum is the only commodity that's still traded on the New York Mercantile Exchange as of this day. Also currently they trade crude oil, heating oil, gasoline, propane, natural gas, platinum, and palladium. Now, according to the New York Mercantile Exchange, their definition of a futures contract. Now, again, we're talking about a futures market. That means that we are buying or selling an energy commodity for some point in time in the future. So each contract is a legally binding obligation for the holder of the contract to buy or sell a particular commodity at a specific price and location at a specific date in the future. So the components of each contract are, number one, the commodity. What is it we're trading? What energy commodity? Are we trading crude oil, natural gas, heating oil, or unleaded gasoline? The price, which is obviously very important. The location. As we go through each contract, you'll see that each of the energy contracts has a specific delivery location under the contract in order to fulfill the requirements. And then the date. What month or months in the future are we trading for? And there is an agreement. The International Swaps and Derivatives Association has a special agreement called their 2002 Master Agreement for anyone who trades in financial derivative contracts. What does it function as? Well, the first and probably one of the most important functions is price discovery. Okay, we can establish a price for crude oil, natural gas, heating oil, and unleaded for any future point in time. So there's no more guessing as to what the market is doing. Any one of us can look at the Wall Street Journal at the end of the day. We can go online to Yahoo Finance. We can actually go to the Nymex parent website, which is the CME group, and find out where these energy commodities are trading. And then hedging. We'll talk about this in future lessons. But if this is a real market, every contract is backed by the physical commodity itself. Now granted, a lot of speculators and investors are just trading to make a profit, but the fact is they represent real commodities. So those on what we call the commercial side, that is, those of us dealing with the physical commodity who want to buy or sell it, we can do what's called hedging. Okay, by selling or buying the commodity in the futures market, we're guaranteeing ourselves a certain price and delivery of that commodity or a market for that commodity. So we talk about it, the fact that hedging is a way to use futures contracts and related products to reduce your price and or physical risk. Some of the key terms: ask. It's a motion to sell at a specified price. Okay, it's the same as an offer. It's your offered price. And they say motion because we're talking about the traders in the pits, and they do have literally little hand signals that indicate whether they're buying or selling. The bid is a motion to buy at a specific price. It's the opposite of an offer. A bull, in this sense, this is a participant in the market. Okay, so they say that it's one who anticipates an increase in price or volatility. They're the opposite of a bear. So they expect prices to rise. And then a bear is a trader, a market participant, who anticipates a decline in price or volatility. They're the opposite of a bull. So if the market is bullish, that means that we think prices are going to go up. And if you have a bearish market, that means that we believe prices are going to decline. This is just a picture of the trading floor. Just so happens in the foreground, the pit there is the natural gas trading pit. To the left is the crude oil trading pit. The various jackets mean different things. The jacket colors other than yellow are various brokerage firms and clearing firms. The white shirts, those are the dress shirts. Those are what we call the locals. They're investors or they're individual speculative traders. And then all the yellow jackets, those are going to be Nymex personnel and Commodity Futures Trading Commission compliance personnel. So some of the people you see out there, floor brokers, the clerks. There's a lot of clerks who basically are working either in the rings, they're at a booth, they're phone clerks, and then they're also ones who give others breaks. Locals, as I mentioned, these can be large investment firms. They can be equity and hedge fund type of groups who are strictly trading for profit. Small ones, these are people with a substantial amount of money who trade for their own book. And then what we have are spreaders. Now these people looking for the, it's also known as arbitrage. They're looking for opportunities between and among commodities. Ring reporters, these would be Nymex people, the ring chairman. They're overseeing the various pits. You've got all types of floor committee members. These would be Nymex committee people who are going around the floor, make sure everything's flowing smoothly. You have the Nymex compliance people as well as the Commodity Futures Trading Commission compliance people, and then various Nymex staff. So again, these are all the different participants who are on the floor. Unfortunately, as we'll talk about in a future lesson, electronic trading of the Nymex contracts has really caused the number of actual physical traders in the pits to dwindle. We're probably down to 50% or less of the people trading in the pits these days. Okay, the first contract we're going to talk about is the crude oil contract. Now the symbol is CL, and it's what we call West Texas Intermediate Low Sulfur or Sweet Crude. Because the content is low, the sulfur content is low, they refer to this as sweet crude. So we talk about West Texas Intermediate or WTI. It's the standard under this contract. Okay, it was launched in 1983, and every contract, whether you buy or you sell a single contract, it represents 1,000 barrels of crude, which is it was approximately 42,000 gallons. So this is what I meant by the fact that there are actual commodities backing these contracts. Okay, it's traded in U.S. dollars and cents. That is the world crude oil currency. Minimum price fluctuations. This is just the amount that has to occur before one trade is basically put on the board. And then the delivery point is free on board or it's delivered. It's the seller's facilities at Cushing, Oklahoma. Okay, any pipeline that's there or a storage facility at the Cushing point. And these are just two of the big companies that are there, TEPCO or Equilon pipeline companies. And we'll talk a little bit more about Cushing later on, but it is a major hub and it is the delivery point. If you buy or sell futures contracts on the New York Mercantile Exchange for crude oil, the place that the physical contracts take place, or get the commodities exchanged, will be Cushing, Oklahoma. Okay, deliveries are to be made uniformly across the month. That just means that, for instance, let's say that you're going to buy 1,000 barrels a day of crude oil for the month of July. Well, there's 31 days in July. Your real obligation is to purchase 31,000 barrels. Now, the Nymex wants to schedule everything uniformly across the month. But contractually, as long as you receive the 31,000 barrels by the end of July, you have complied with the contractual obligation. The trading hours, you have the open outcry or pit trading. Okay, this is what we would consider to be normal hours. And those are from 9 a.m. to 2:30 Eastern Time, and that's Monday through Friday. Now, the parent company, the Chicago Mercantile Exchange, or the CME Group, has an electronic trading platform known as Globex. Now, they actually start trading on Sunday nights at 6 p.m. Eastern Time, and it's around the clock until 5:15 on Friday afternoons, again, Eastern Standard Time. For crude oil, you can trade out 9 consecutive years if you had the need to buy or sell for that long of a period of time. However, the issue becomes whether or not you're going to find counterparties who would be willing to buy or sell with you. We talk about strips. Now, a strip, it just means a strip of prices. So anything more than a month could be considered to be a strip, all right, all the way up to potentially 30 consecutive months. A few of the more popular ones within crude trading, you have what's known as a 12-month strip. So, for instance, if next month is July, from July 1st of the current year through June 30th of the following year is considered to be a 12-month strip, rather than have to go out and buy 31 July contracts and 30 June contracts and 31 August contracts. The broker you're dealing with on the New York Mercantile Exchange will just go ahead and give you an average price across that 12 months. We also talk about a calendar year strip. A calendar year strip would obviously be an entire calendar period. So, for instance, January 2016 through December of 2016 would be a calendar year strip. So that's what we talk about. Strips are just multiple months that could be executed at an average price. The last trading day, since we're talking about future contracts, when you get closer to that next month, the contracts have to be settled up. Okay, in the case of crude oil, it's 3 business days prior to the 25th of the month. Okay, now if the 25th is a non-trading day, it's a holiday, or let's say it's a weekend, then it's going to settle 3 days prior to that business day. And the point being that, for instance, let's just say if you're currently buying or selling July crude oil, well, all those positions have to be settled by the end of June, because you actually are going to have to start the physical exchange for all those contracts where the actual commodity is going to be exchanged. Well, that has to start on July 1st. Now, margin requirements. This is important. The New York Mercantile Exchange wants a certain amount of money in an account to guarantee against potential losses that you might have from buying or selling contracts. Because again, keep in mind, you're buying or selling them now, and you're not going to balance your position until the actual settlement. So as of the time that I put this lecture together, the per contract amount was $4,450. This also discourages some participants from trading a whole lot of contracts and holding on to them from day to day. This would make a lot of the so-called day traders get in and get out of positions. Otherwise, they could have potentially a substantial amount of their cash sitting in a margin account. These are the symbols. You can see here when I'll show you a screenshot, but again, the first 2 letters in the code, CL, is the commodity. It's crude oil. The second letter in the code is the month of delivery. Now, the Nymex has specific monthly codes that I show at the bottom. So for this example, I'm using N, which is July, and then the final symbol is the number that corresponds to the year. For instance, 5. Okay, so we have then, using that example, the July 2015 contract for crude oil on the New York Mercantile Exchange would show up as CNL5. And then the other symbols that we're going to deal with, NG is natural gas, HO is heating oil, RB is unleaded gasoline, and PN is propane. And before I show you the screen, I'm going to show you some of the headers, these column headers. When we see last, it just means the most recent trade that was posted. What was the last trade that took place? Direction was that last trade that we're talking about. Was the price higher or lower than the trade that just occurred before that? Okay, net change. This is something we're very interested in. What's the change in price from the previous day's settlement? So when the contract settled the day before and there was a final price posted on the Nymex exchange or in Wall Street Journal, wherever else, what's the current price relative to that? Is it up or down from the prior day? The open, that's the exactly the first opening trade. When the bell goes off, when you see those people standing on the floor of an exchange, whether it's the American Exchange, it's the New York Stock Exchange, or Nymex, and they ring that bell, the very first trade that takes place, that price gets posted. That's the start for the day. Now the high, that's the highest trade for the day thus far, and that includes the overnight trading on Globex. Okay, and then the low would be the lowest price for that day's trading, again including overnight trading on Globex. If you see previous close, that just means the prior trading session's closing price, the prior day settlement. Now, as a side note, we talk about the fact that this is a zero-sum game. If I'm going to buy contracts, someone has to sell them to me. So for every winner, there is a loser. But in reality, less than 2% of all the contracts are going to go to physical delivery. That is, less than 2% of the contracts traded, the commodity will actually be exchanged at Cushing, Oklahoma. Now, that might not seem like a whole lot, but you're trading thousands and thousands of contracts a day, and every contract represents 1,000 barrels of crude oil. So you're trading millions of barrels of crude oil a day. So when you start to look at 2%, it's not that small of an amount. Okay, and here's what a screen would look like. As I mentioned here, you can see at the time that I put this particular slide together, the March contract was the near one. And you can see here it says March 15, Nymex, light sweet crude oil, WTI, futures electronic. That means it's trading on the electronic platform, which would be Globex. The last price was $46.68. It was down from the prior trade, and actually it's $1.10 less than the prior day. And if you look all the way across to the previous close, you can see that was $47.78. The last trade was $46.68. Thus, we've got $1.10 down from the day before. The opening price of the day was $47.35. The high thus far this particular day was 49.09, and the low was 45.87, and that's quite a large range. You've got about a little more than $3 trading on the range for the day. So this is what a typical future screen would look like. Okay, natural gas, another key contract we're going to deal with. This is traded in 10,000 MMBTU units. Okay, MMBTU, if you remember from your Roman numerals, M is 1,000, and then M is 1,000, so 1,000 times 1,000 is a million. So you've got million BTUs are the units, but every contract is trading 10,000 million BTU. That's a huge amount of energy. We're still trading in dollars and cents. Each trade has to move about $10 per contract. Same trading hours. Now with natural gas, you could go out 118 consecutive months. Again, provided that there are counterparties out there willing to trade that far, and quite frankly, beyond 5 years, there aren't too many parties interested in buying and selling. The last trading day is the third business day prior to the first calendar day. A little bit different than the situation with crude oil. It's actually the third business day. Options, we'll talk about options in a future lesson, but the options have to expire and be settled the day before the actual futures contracts do. Now the delivery point, as we talked about with crude oil, every contract has a physical delivery point for those who choose to actually exchange the molecules. It's what's known as the Henry Hub. Now Texaco, near Erath, Louisiana, has what they call their Henry plant. This was selected as the delivery point under the Nymex contract by the Nymex people. Okay, the seller is responsible for moving the gas through the hub, and then the buyer takes it away from the hub. And Sabine Pipeline Partners runs the hub, and they pick up a 2-cent fee for this particular exchange. Here's a schematic. These are multiple types of pipelines. You have gas coming from offshore platforms. You have gas coming from South and East Texas. You have gas going to the southeast United States, the northeast part of the United States, the upper Midwest. So when we talk about a hub, we're talking about an intersection of pipes which allows for extreme flexibility in terms of receiving and delivering gas. The settlement price. Now every day the New York Mercantile Exchange calculates the settlement price, and that's what we see posted in the Wall Street Journal or other financial sources of data. Okay, it's the weighted average of all trades occurring during the last 2 minutes of trading during the regular day session. So in essence, using Eastern Standard Time from 2:28 to 2:30 every day, Monday through Friday, the New York Mercantile Exchange calculates all the trades that occurred during then, and they come up with a weighted average price, and that becomes what's known as the settlement price or the final price for that day. Now, every month, as we mentioned, the near month contract, the closest contract, rolls off. So if we're dealing with the July contract, it will have to be settled 3 business days prior to the 1st of July so the deliveries can take place. Well, on that day, the Nymex goes ahead and they calculate all the trades that occurred in the last 30 minutes. And then they post that, and that particular contract is now in the history books. Okay, margin requirements, currently $4,000 per contract. And this is what a typical natural gas quote screen would look like. Same headers as we saw for crude oil, obviously different pricing. Unleaded gasoline. Unleaded gasoline these days that's traded on the New York Mercantile Exchange is known as RBOB. It's the reformulated blend for oxygenated blending. It represents a feedstock for unleaded gas, or 90% of the finished product. In essence, when you go to the pump, okay, unless the pump is labeled 100% unleaded, which is what's trading on the New York Mercantile Exchange, it's generally been blended. Okay, you see the 90-10 or the 85-15. The 10% or the 15% is some type of blending agent or oxygenator. The most common one is ethanol, but there are others. You can have ethane, butane, isobutane, and natural gasolines, and these are seasonal in nature. Okay, every part of the country in each different season has a different blend, and it has to do with emissions for the most part. Each of these contracts trades 42,000 gallons, and again, US dollars and cents. Okay, the delivery point here is in the New York Harbor. There is what's known as the petroleum products terminals, and again, similar types of restrictions in terms of deliveries. Now, the last trading day for this is actually the last day of the month. Okay, margin requirements are a little bit higher here, currently $4,700. Then we have heating oil. Heating oil, the symbol is HO. It's also known as number 2 fuel oil. Again, it trades in 42,000 gallons. The price quotes U.S. in dollars and cents. The delivery point, this is also the petroleum products terminal in New York Harbor, and the last trading day is the last day of the month, and then margin requirement currently for heating oil is $4,600 per contract.